Okay, let's get in. Trideep Bhattacharya, CIO, Edelweiss AMC, joining us on the show. Trideep, can we say season's greetings to you? I'm not sure whether we'll have one more interaction before we close out the year, but great to see you this Tuesday morning.
Good morning.
Hi, good morning. So what's the call going into 2026? And then if you could tell us about the underpinning of optimism, because 2025 has been a bit of a challenging year. So the underpinning of optimism going into next year is a pickup in earnings. What are your channel checks suggesting about how Q3 is going to shape up in terms of an EPS growth, the sectors which will lead, the sectors which will lag? And is there any risk of an earnings disappointment? I mean, tell us, based on your interactions with the managements, in Q3, what should we expect?
Sure. So, good morning. Thanks for having me on your show. And yes, one of the critical parameters that we monitor is how earnings are incrementally moving. And one of the reasons behind the consolidation that happened in the market last year was lackluster earnings. We actually cut our earnings by almost about 10 to 12% over the last year or so. And for the first time in September quarter, we saw early signs of an earnings upgrade cycle starting up. And from what I'm hearing as channel checks into the Q3, I think certain sectors more than others are certainly looking better, but net earnings are looking better than what people initially thought about. One is on the consumer discretionary side. Certainly, the checks seem to suggest that whether you look at autos or some of the big ticket consumption, the uptick seems to be sustaining. That's one. Secondly, while overall from a financial standpoint, some of the segments within financials are actually bottoming out. So we're going to see a little bit of a bounce back with regards to growth rates in the sector. These two sectors are, from the channel checks so far, seem to suggest that demand is holding good and in fact turning towards the better. IT, the furloughs have not been impacted as much. So broadly in line is what I would say. And that's what the channel check seems to suggest. So, which is good news, given what we have seen in the last few quarters. So far, the earnings season expectations for the immediate quarter seems to suggest that earnings will likely hold up, which is good news heading into New Year.
So for auto in particular, just to go a little deeper, what's the expectation of an earnings improvement? I mean, do you have more granular details? Because the sector has also done very well ever since the announcements of GST cuts. So even if earnings deliver, can there be upside in stocks from here on?
I think overall, the September quarter numbers, when they came through, while the numbers are better than expected, I think most of the estimates on the sell side didn't change all that much because everybody wanted to see that follow through onto the December quarter numbers before they change the full year numbers. That, I think, will finally come through with this quarter numbers, particularly for the consumer discretionary sector overall. And that's what I'm talking about. So I would say that, yes, versus the current estimates which are baked in, so far, I would say that we could see an earnings upgrade of about 2 to 3% come through with regards to even the expectations that we are on two sectors that I talked about, consumer discretionary and financials.
Okay, all right. Well, Trideep, just wanted to narrow down on maybe a couple of sectors. We were just discussing the entire railway space just some time ago, and it's going to be in focus going into the budget. Is that a sector which would pique your interest at all?
Not as much as in the past, is the right way to put it. I would say that overall, if you look at Modi 2.0, it was all about capital goods and different elements of infrastructure coming into third gear and fourth gear. In Modi 3.0, the party is split between consumption and infrastructure. And hence, because the overall spend is split between these two areas and little more emphasis on consumption, and we have seen plethora of measures like GST reforms, tax cuts and whatnot. And next year, we have 8 pay commission coming through. On the other side, the infrastructure investments would likely be more selective going forwards. So rather than having a broad-based spend in railways, maybe Kavach or certain components of railways will see investments and broadly at flattish level. Within infrastructure, though, the areas that we see continued strength in spend from a government standpoint will be defense. That's an area we clearly see that even Y on Y as we head towards budget, I wouldn't be surprised if the allocation toward this space increases meaningfully versus what we have been used to in the past.
All right. Hi, Trideep. Good morning and good to see you, Ben. What are you making of these newly listed companies? Lenskart, so much of debate. The stock actually has done pretty well post-listing. It could be a limited float factor as well. Grow has done pretty well. While on the flip side, something like an urban company listed, went to 200 rupees and then pulled back big time. Any of these stocks you like, which are worth looking at post the recent correction? Meesho, case in point. Stock went up big time. Yesterday it was at lower circuit with no buyers.
So, of course, we can't talk specifics, but 2 or 3 things that I would like to highlight here. One is, given how this new age IPO companies are popular at the time of the IPO, the anchor allocation and the main book allocation is hardly little, and liquidity in some of these stocks is really challenging. So I think one should evaluate the performance of the stocks, not from the listing price standpoint, but after 1 month and 3 month lock-in opens. That's when one has decent enough liquidity and true price discovery happens over a period of time. So hence, the right price discovery we will figure out over the next 3 to 4 months with regards to these IPOs. So we don't get excited. Bottom line is we don't get excited by the listing day price move. Some of these names are certainly in our portfolios. While I can't tell you the names, what I could say is that stocks which have unique business models, who have a path to profitability and unit economics are kind of in their favor, we certainly kind of look to hold them. Though I have to say that of late some of these IPOs are priced pretty finely. So we would use price declines to build our position rather than be very aggressive on a day-on-day basis is the way I would put it.
Deep, as a house, what is the call on gold and silver? Are we in for a correction after what's been an extraordinary year for precious metals? Or do you think the rally continues? And what could be the extent of any correction? Because correction is natural in the normal course of any asset.
The way I think about equities and gold, these are the 2 ways where over the medium term are good instruments to beat inflation overall. And ultimately, given that broadly, we are entering into a tariff-led world is likely to be more inflationary than what we have been used to before. Now, of the 2 asset classes, when earnings estimates are coming through, equities would tend to do quite better, would turn out to be better inflation hedge. But when earnings estimates are not coming through, precious metals do the hedge component and kind of, do well. Over the last 12 to 15 months, earnings estimates have been lackluster. And that partly explains the strength in precious metals, along with the worries about various global currencies. My sense is if we do get a sustained earnings upgrade cycle come through, equities would do better than precious metals. Of course, for that, the tariff and some of these areas which we have not resolved so far needs to resolve. But if they were to come through, then 2026 equities might do actually well, and gold and precious metals might actually see a bit of a healthy correction in the context of asset allocation.
Okay, Trideep, I don't know how much you've possibly looked at this entire GLP-1 opportunity, but it is expected to probably add 1 to 2% to the pharma growth. And all of this conversation is coming at the back of Novo Nordisk also getting approval from the FDA for a weight loss pill as compared to the injection, which is tougher to take. So just give us a sense, are you looking at pharmaceuticals in India from that lens as an opportunity?
Indeed. And we have positioned our portfolios to benefit from this. And for the benefit of viewers, while GLP-1 turned out to be the primary reason of popularity initially was diabetes and the result for that. It is obviously touched upon a far bigger market, which is the weight loss market or the obesity market, which is one of the issues to deal with. And hence, we do think that it will be globally, not just in India, a fairly popular area with a large TAM, if you may call it that way. The idea is to find those companies which can capture this opportunity profitably in their P&L and balance sheet. Indian companies particularly are looking to launch of the generic version sometime mid of next year. As and when that happens, a few companies will benefit more than others. And I can tell you in the context of pharma, we are certainly already positioned in there and would look to kind of continue in that direction.
Okay. All right, Trideep, we're going to let you go on that note. Thanks very much for joining in and speaking with us and giving us all of your perspective in terms of the markets. Well, for the Nifty is